Brian Manning here with your weekly update. I know it's Thursday, but I'm out of the office all day tomorrow at a mortgage event for Building Champions. So a lot of good information this week, so not wanting to pass up this week's weekly update. So let's get right to it. Monday this week, quiet news day, not much to talk about there. Tuesday, we got the PPI, so that's the Producer Price Index. This measures inflation at a wholesale level. Doesn't always, but could translate to inflation that will trickle down to us as consumers, and huge leap with PPI inflation being up 2.2%. Also on the core rate, we had, which strips out volatile food and energy, was up from 1.2% to 1.5%. So just continually seeing inflation here. Also got some housing info from CoreLogic on Tuesday this week. Serious delinquencies, as people with mortgages that are more than 60 days late, are down 30% year over year. So just phenomenal to see the recovery in the housing market over the last couple of years. Wednesday of this week, big, of course, huge day. First, we got the CPI, that's the Consumer Price Index. That is what we in the mortgage industry primarily look at to gauge inflation. And CPI number was up at 2.7%, well above the Fed's target rate of 2%. And we look at this as the primary inflationary gauge because it's inclusive of housing expenses and out-of-pocket medical. There's another gauge we talk about, which is the PCE, Personal Consumption Expenditure, which the Fed looks at. But the PCE does not take into account housing or out-of-pocket medical. And I just don't know anyone that's living for free and doesn't have out-of-pocket medical expenses. So we really think CPI is more in line with what's happening with inflation. Again, 2.7%, well above the Fed's target at 2%. Also, Fed meeting, we got a 0.25% rate hike. Everyone expected it. Markets expected it. Overall, Janet Yellen's testimony and questions were very much in line with what people were hoping for. 3 rate hikes this year, so 1 down, probably 2 more to go. Should have it, employment is strong, inflation is increasing, no reason not to have these rate hikes. But if we get a Fed rate hike yesterday, why did the bond market react favorably and mortgage rates go down? And we talked about this. So the enemy of the bond market is inflation. And for quite a while now, inflation has been well above the Fed's target rate. When the Federal Reserve raises their rates, that is actually done to cool off inflation. So it makes bond markets happy. We see some retreat there. You see some retreat in the 10-year Treasury yield. Favorable for interest rates. So we've said this before, even though the Federal Reserve raises rates, that does not mean that mortgage rates will follow suit as well. After Janet Yellen's testimony, is always question and answers. We've talked about this in the past. The first question Janet Yellen was asked was, what are they going to do with their mortgage-backed security reinvestment program? So right now the Federal Reserve is buying $8 to $9 billion a week of mortgage-backed securities, which is artificially keeping mortgage rates down. And Janet Yellen said that the Fed would like to lighten their balance sheet, but they're not going to do so anytime soon. So what that means is they're going to keep investing in mortgage-backed securities, artificially going to keep rates low. Markets very much like that and reacted favorably as well. So really good to see a little calming down of the interest rate trajectory we've been on for quite a while, which has really been a rising rate environment, and that's kind of stopped in its path as of yesterday. Lots of great news. I'm around. If you have any questions, you want to talk about this more, please give me a call. As you can tell, I love talking about this stuff, and I'm all about educating people on the financial process, especially what's happening economically and with mortgage rates. Have a wonderful day.